Right, just very quickly, Raggy, yes, why is the YM moving in the opposite way as the ES? It does do that. The three indices, the two indices that probably correlate most strongly is the ES and the NQ. Now, there is a reason for the YM possibly moving in the opposite direction. The YM does not, or the Dow doesn't really, it's not a tech index. You have to remember each index is made up of obviously individual companies, and what happens is they will have a weighting to perhaps what's called technical tech companies such as Alphabet, Google, let me think, the FANGs, Facebook, etc., etc., etc. It's those stocks that have been dragging the market higher. It's really, when you see an index like the NQ blasting higher and the ES, what people don't realize, it's actually been pulled up by a very small number of stocks. It's not healthy. With regard to the YM is really configured from what are called more value stocks. They're kind of a little bit old, well, I suppose you call them old-fashioned, because tech is very sexy, because it tends to be more volatile. So that's why you have the differential in the moves between the YM and something like the NQ and the ES. What the YM or what the Dow is trying to do is there's recently been a rotation out of what I call more traditional stocks. For example, Exxon was removed from the Dow and it was replaced by Salesforce. So if you like, value companies tend to be, as I said, quite perhaps mundane companies, older companies, because the Dow was lagging. Now, it could just be that two things. First of all, those tech stocks that went into the Dow, and I think Apple also went into it. Wasn't actually part of the YM. And also, if you do a search online, you will find that a stock such as Apple will be in more than one index, but it will be in a different percentage of that index. The way indices work is actually really, really fascinating, and we are thinking about, well, I know we will be doing later on a program for stocks and possibly options, and one of the things is to recognize how an index is configured, because the people who put the index together, you can configure it in such a way that it's always going to look sexy and people will move into it, but not necessarily represent what the economy is actually doing. So there's a sort of politics behind it, so it's very, very interesting. But the YM, as I said, until this rotation out of stocks like, Exxon has been removed, a huge company. It's obviously a petrochemical company, and replaced by Salesforce. What does Salesforce do? It's cloud-based, it's tech, yeah, but does it actually make anything? No. Anyway, I won't go down that route. So, Renko and Trading View, is there David's answered that. So I hope that answers that question. You've done that as well. No, that's it. Okay, right. I am just going to pass over to David. I think I'm probably going to be about done with that little move on the YM, because it's simply at the volume point of control. So unless something quite dramatic happens, I think that's probably where it's going to stay, just oscillating, trying to move away one way or the other.
Thanks, darling. Just hopefully you can see my screen. Hopefully you can hear me. Just move the chat box out of the way. There we go. Okie dokie. Really just reinforcing the fact. Let's get rid of that. Oh, what that's doing there. Stuck in the middle. Go away. It's detached itself from the chat box. I'm just going to move it out of the way. There we go. This is on the three indices, just to pick up that point. This is the YM. Bottom in the middle, we've got the NQ. Over on the right hand side, we've got the ES, all on the dailies. Top line is 5 minute. I'm really just reinforcing what's going on at the moment, all trading around the volume point of control, very much in evidence, not going anywhere, lots of volatility, back inside the spread of the candle. It's tradable. If you want to move down to the 15-second, I'll show you. But basically, as a rule of thumb, if the markets are in this kind of condition, and we know why they're in this state, because they're waiting for the news, then if you feel compelled to trade, you're going to have to go down into the very fast timeframes to actually have any chance of making money at all. Doesn't suit everybody. I use the 15-second, I use it a lot, but it's not everyone's cup of tea. And if this is not your cup of tea, it's not your bag, then the best thing to do is to wait, be patient, wait for the news to come out, wait for the inevitable volatility, look at the volume, and then maybe 15, 20 minutes after that news has gone through, maybe if you can detect a trend that's developing, then trade it after that. But in the run up to it, it's probably going to be like this for the rest of the day, for the next sort of 3 or 4 hours maybe. So that's where we are at the moment. In terms of the dailies, yes, we have had a lot of divergence between the, let's move that out of the way again. There's a lot of divergence between these three indices. Normally you'd expect to be going up and down together, but we've seen it a lot over the last few months where we've had the NQ rampaging higher, the ES perhaps following it, the YM maybe down even, so we've had down days with up days and vice versa. But as you can see at the top here, we're just trading around the volume point of control. So if we go over onto the multiple time frames, where are we? There we go. I've got the YM on here. Starting with the 15-second top left, that's the 1 minute, the 3 minute, the 5 minute, the 10 minute, and the 15 minute. And on every single one, you've got the yellow dashed line of the volume point of control, which really tells you in a nutshell all you need to know. There's nothing going on at the moment. It's congestion. If you want to trade it, yes, it's tradable, but you've got to be quick. Yes, there are these sorts of moves coming along, inevitably on a very fast time frame, but as I say, it's not everyone's cup of tea. The reading volume and price in this sort of speed is great. It's very good. It sharpens you up. All the lessons are exactly the same. It doesn't matter the fact that you're looking at a very fast time frame. The indicators work in the same way. The support and resistance, the volume point of control, the accumulation distribution here in terms of stronger levels and weaker levels of resistance and support. The volume, obviously, you've got the trend monitor on here as well. You've got the volatility indicator. All works in exactly the same way. So in terms of trading anything other than sub a minute, and there's really not a lot going on right now. Let's go and see what's going on in terms of commodities. Let's go and have a look at oil. Was moving nicely. Here we go. Some decent moves on oil. And again, the strength of the volatility indicator. I've got a classic example here. We have this snap move higher. You can imagine oil traders jumping in and thinking it's going to go through 40 and beyond, $40 a barrel. Lots of volume. You can always guarantee one thing. When you're looking at the volatility, what you're looking for is the obviously the spread of that candle, the fact you've got the volatility trigger on here, which is telling you that the price action has moved outside the average true range. And at that point, that candle would have been building very quickly. There would have been an awful lot of traders piling into that on the expectation of a move higher, strong move higher. The volume in there tells you the big operators are involved in that particular move, and then you get the snap, reversal, either into congestion or reversal. Either way, it's the indicator triggers the fear of missing out. That is what volatility does. Volatility is nothing more than a compression of price and time, because if you think about it, if you looked at that candle, for example, where you've seen the market move from 30 up to 65, so 35 cents a barrel, under normal circumstances in regular pricing, that may have taken 3 or 4. We're on a 10-minute chart here, remember, up top here. This may have taken 30 or 40 minutes, maybe 3 or 4 candles. All that's happened is that move, that spread of price has been compressed into a 10-minute, one single 10-minute candle. And that's all volatility is. It's just a compression of time. And the reason it is so powerful is because it triggers one thing, which is the fear of missing out. If you see a market that's fast moving, we are all DNA hardwired to jump into that move and to make what we think is going to be some quick, easy money because it's fast moving. Generally speaking, the markets are relatively slow moving. They're relatively even pace, but then you get these snap moves, the market jumps one or the other, and you think, terrific, I'm going to jump in. Invariably, this is what happens. It's either a congestion phase or a full-blown reversal. And the reason it's so powerful, and the market makers know it, and the big operators know it, they know the emotional trigger that is fired inside you when you see a market that's fast moving. You almost can't help yourself jump in, because it's that sense that I'm missing out. The market's fast moving. Maybe you've been sat through some congestion, even more powerful when it follows congestion, because you've had the boredom factor has first of all been built in. Then you see a snap move. You want to jump in because you want to make some money. We're here to make money. We're not here to watch charts all day long and do nothing. We've got to make some money. So we jump in, crash, bang, wallop. What happens? Congestion or reversal. That's the power of the indicator. It just gives you an instant warning. The problem you have is that if you're in a trade, if it's positive for you, it's great. Then I always recommend you close out, take the money off the table, and because if the market continues higher, if this has snapped on higher, fine, you've lost nothing, you can always jump back in again. But if you're sat in this now, it's painful. And that's what it's all about. It's all about the emotion of pain, which the market makers and big operators understand extremely well, which is why, let's face it, they've been doing this for many, many years. You see it at every opportunity. You'll see it at the open of the London markets, Forex markets. You'll see it at the open of the London the US markets. You'll see it as the cash markets open alongside Globex. You'll see it everywhere, all the time. And you'll see it in different time frames. We've got it, down on the daily. We had one not so long ago written about this. We had this very sharp move lower. Then we had this explosive day. Nice move, good volume, volatility trigger. What are you expecting? You're expecting one of two things, either congestion or a reversal. We've had the congestion. The market is now trying to rally. Where's it going to rally to? Let's pull this over a bit. Get rid of that. Where is the market going to rally to? Well, self-evidently, if it's going to go higher, it's going to go up to the volume point of control again. That is where you're going to get further congestion, because that's the heaviest volume on the chart. So in terms of a longer term trading opportunity, once we get past the top of this previous candle, there's a dollar per barrel there up to there, and then we're going to see congestion build thereafter. Oil's been in consolidation for a long time, up at $42.50 a barrel for a while now. Just scanning around, seeing what's going on. You've got more volatility triggers here. Another one, snap move, reversal, painful. Got some buying coming in under this one. You can see it here on the 5-minute. Move to the downside, big wick to the lower body. Absolute ton of volume coming in under that particular candle, ton and a half. You've got a nice platform of support here. That one was breached, but it's closed obviously above that. That's why you're seeing the market reverse, because you've got an absolute heap of volume coming under here. Tons of buying under this particular candle. That's going to take it up again, which is what you're seeing right now. Down onto 15-second. There we go. That's what we're seeing. If this and the trend monitor's transition, we've gone through from bearish into transitional, out the other side into bullish. It's what the indicator's designed to do, to keep you in, to help you stay in, to maximize the potential. You can see we have this little reversal here, but look at the volume. The volume is falling away. What does that tell you? It tells you that if the market's moving lower and the volume is falling, it's not going to go very far, because the market requires effort to move up as much as it does to move down. Just pop that back down again. Let's just go over to the indices again, see what's going on, see if anything's changed. No, still trading around there. A little bit of a breakaway on the NQ, but still trading heavily around the volume point of control. Let's go and see what's going on in gold. I'm just keeping an eye. Sorry, I'll just pull this over for you. This is the VIX on Trading View. Pop that up there. This is on 1 minute, 5 minute, 10 minute, and over to the daily. And really, this sums it up down here. We've had this snap move. We're trading around, moving sideways, trying to rally, trying to move, but it's really not going very far. You can see it here. We're in congestion. There's no direction on the VIX at the moment. The indices are going to move, then you'll see it reflected on the VIX. Let's just go on to gold. There we go. Gold's trying to claw its way back to 2000. We're still bullish on gold. Let's just have a look at the chart, see what the charts are like. Okay. And one of the things you're always looking for in terms of volume price analysis is anomaly. An anomaly comes in many different flavors. But one of them, for example, is in this 3-candle move here. You've got the first two. The first two look okay. You've got perhaps this volume here should have been a little bit higher than this one because the spread of the candle is wider on this one than it is on that one. So, you know, that looks a little bit odd. But then you look at the next one, almost twice the volume, but actually the spread of the candle's gone nowhere. What does that tell you? It tells you that there's a lot of selling going on in this particular area of price. It tells you that the market is weak. It's trying to rally, but it's rallying on heavy selling that is knocking it back the whole time. So the big operators, the market makers, whatever market you're looking at, if you see that sort of activity, then it's telling you that, you know, this is anomalous, because if you look at the previous 2 candles, what you would expect to see on this candle is pretty much the same. You'd expect to see a similar sort of volume as this, you know, and certainly not almost double. So what is that telling you? It's effort and result. It's telling you that there's a hell of a lot of effort going into that particular candle, but it hasn't actually resulted in what it should have done based on these 2 candles. And remember, when you're looking at volume price analysis, you're always trying to compare, or you always are comparing it within a session. You can't hop over and compare it with a previous session. You've got to compare like with like, apples with apples, for example. So it's anomalous. It doesn't roll straight away, but you get a nice signal here. You get a 2-bar reversal in effect, because this is a bearish engulfing candle, basically engulfing that one. If you add these 2 together, what have you got? You've got a little body like that and a big wick to the upper body. So in other words, this is on a, what are we on here? On 3-minute chart here. So if you're looking at this on a 6-minute chart, that's what you would see, pretty much all things being equal. And then it starts to roll over and you get the move to the downside. Now we're starting to see some buying coming in here, a little bit of it here, a lot of volume, but the market hasn't fallen perhaps as much as you expect. It's an inverse, if you like, of this. So again, this is kind of anomalous, because when you're looking at that one and that one, market's rising, that's fine. Then you start to see the 3rd candle and you think, hang on a minute, why have I got so much volume in this one? I've got less volume in that one. So there must be a good deal of buying in here. There's a little bit of buying here, there's more buying here. Now we're starting to see this rally develop. We've got rising volume, rising price. So now we're probably going back up again. Maybe not that far, because the general sentiment here is still bearish. So we haven't yet seen a transition in terms of the trend on that particular time frame. Please go down onto the, go to the 1 minute. There we go. And then you start to look at it from a different perspective, different time frames, similar sort of things, similar pictures. You're looking at the volume, you're looking at you know, what's going on here. You've got a volatility trigger here, lots of volume coming in, same sort of principle. Bang, up it goes. Traders jumping in, they get squeezed in the reversal into congestion, which is what you expect. More weakness confirmed here. And again, it's another facet of volume price analysis, is that things don't happen instantly. It's very unusual that you get a signal, a clean signal, and you get an instant reaction to it. Sometimes you do, but generally speaking, what you get is you get a signal, then maybe some congestion, then a further signal, maybe another signal, and then ultimately the market rolls. So don't expect to see, you know, you get quite excited when you see these very strong signals, think, great, market's going to reverse, I can jump in, etc., etc. So, yeah. Yep. Sorry, I always have the chat box closed when I'm in full ramp mode. Tony Wilson, is day trading the US market session more about indices and stocks? Generally speaking, Tony, yes. Anna often does Forex first, and then we go into indices, commodities. She just hasn't done it today, but generally speaking, yes, it's more about futures trading, day trading, indices. We do commodities and stocks, that sort of type of thing. Raggy, how can you tell when the stock is in accumulation? I am asking because I've seen stocks trending up strongly, then consolidate, then make new highs. You look at it in multiple time frames. Accumulation distribution applies to all time frames from a 1 minute time frame to a 1 month time frame, and the only difference is that clearly on a 1 month time frame it's going to be extensive. It's going to last for months, possibly even years of accumulation and distribution in a stock. On an intraday basis, you see it from the fastest time frame through to the slowest, exactly the same principles. When you see distribution going on, you'll see selling, you'll see weakness, you'll see stuff like this, for example. You'll see lots of volume going in, but no advancement of price. You'll see confirmation signals like this. You'll see all sorts of signals, but basically it is distribution into a weak market top. But that market top can be an intraday, and if you were looking at a 1 minute chart, you could have a complete cycle from accumulation, distribution, back to accumulation. On a 1 minute chart, that could happen over 90 minutes, let's say, 2 hours, whatever. If you go up to a 15-minute chart, that might last several hours. If you go up to an hourly chart, that might last several days, and so on and so forth. The principle is the same. It's just the combination of heavy selling in distribution and the accumulation buying phases. You've got tests that come in. We explain it all in the Forex program, but it applies equally to stock markets as well, and exactly the same principles apply. It's all based on Wyckoffean accumulation and distribution of heavy buying, heavy selling, weakness, strength, and it's all to do with the volume profiles that you see, but the time that goes on for will depend on the chart that you're on. As I say, if you're on a daily chart, those phases could last weeks and months. It's what you see all the time in terms of, you'll see a stock, it's falling, it keeps falling, it keeps falling. Then it gets to a congestion phase. Then you start to see the stopping volume coming in. Then you start to see the gradual accumulation, the diminishment of, or the diminishing of volume of buying, or selling rather. So the selling is weakening. The sellers have been sucked out of the market. Then you'll maybe see a test of whether that selling has been completely absorbed, and then off you go up to the upside and on, and so the trend continues. It is a cyclical trend that happens in all markets, of accumulation to distribution and back again. Let's just, where's my time and sales gone? There we go, time and sales window. I'd like to have that up as well. This is time and sales, just gives you a view on the order size going through. I'm not interested in the 1s and 2s going through, they're just noise level. What I'm looking for is the big blocks of 20, 30, 40. I can't remember what I've got as a minimum set up here, but there is a trigger on it which will highlight those big blocks going through. And the key is when those big blocks arrive, how's the market reacted? Has the market jumped? Has it moved? Has it not moved? Tells you everything you need to know about the strength or weakness of the market, as how it reacts when these big blocks go through on the time and sales, because these are confirmed sales. This is not depth of market where there's a lot of spoofing goes on. This is time and sales where these are markets moving through the order flow. You've got 14, anything over double figures. You've got a nice 27 block gone through there. What I'm looking for is much bigger blocks than that. Just see where this is going. Nice decent move. Can't remember which chart we were on. Were we on the 3 minute one? I think, yeah, 3 minute. There we go. Okay, there we are. I really just triggered off this sort of phase of price action here, of some buying coming in. It's looking okay. What's looking okay about it is the wicks are very much at the bottom of the candles. You can see here in the move higher. So it's telling you that yes, the market is trying to rally, and every time the market falls, there's some buying coming in. There's buying coming in. A little bit of buying here. This is not too bad, but you want to see nice strong candles. So it's on the uptrend, but it's not it's not particularly strong. Let's go down onto the 1 minute. Got some real heavy volume ahead of you, in this area here. This is on the volume point of control, and this is another facet where you look at in terms of Support and resistance from the price-based perspective, which is what the accumulation distribution indicator is all about. All these levels here, thicker and thinner levels, they're all based on price. Now you've got the volume point of control jumping down to this level, so you expect congestion. Why? Because this volume has now exceeded this volume here, so it's moved, it's jumped up here, got a ton of a volume to battle through. So is this market going to move swiftly through there? Answer no. It's going to congest like the indices are at the moment. You've also got a volatility trigger on 15-second. It's not as important as on a 1 minute or a 3 minute or a 5 minute or a 10 minute. Nevertheless, you've got one. Short phase of congestion. Looks as though we're going to try and push higher. We're moving up to the volume point of control on 1. And coming up to on the 5 minute, we've got an absolute ton of stuff to fight through. This is on the accumulation. This is price-based resistance, which is now coming into effect. This has been tested 7 times, so it's pretty strong. The volume here builds rapidly. You've got 26 reasons here why this market's going to struggle at this level. You've got the volume point of control. You've got this monster region above it on the accumulation distribution. This is extremely strong level here. Immediately above it, you've got a level below it. You've got this level that's being tested now. You can see it's struggling at that level. Plus, you've got to wade through all this volume on the chart as well. It's going to take a heap of volume to drive through that. You know, it's not looking particularly strong. So if you're going to jump in at that point, I'd say, you know, probably not the best thing to be doing right now. And that's what it's about. It's about analyzing the charts in multiple time frames. Just going to have a look and see what's happening on the futures, on the indices, still trading around the same region. Minor move on NQ, YM still the same place, ES followed, and really it just highlights this kind of divergence. You know, we had half decent move there, half decent move there, but the YM did really nothing much at all, coming back up onto the VPOC again. Just see if there are any questions there. Nope, that's it. So I'm afraid it's a question of waiting and being patient. If you're not comfortable trading the faster time frames, then it's a question of sitting it out, waiting till the major news releases come and gone, and then jumping in and hopefully once you see something in the market, then jumping in and taking the opportunity. But if you're not comfortable trading fast time frames, then I would suggest it's a kind of wait and see. Or you move to other markets, and this is part of the problem. When you set yourself up as I am only going to trade indices, what do you do at times like this? You might find other opportunities in commodities, other markets. It's the perennial problem that we all have to face. So you have to decide what it is you're trading. We trade pretty much everything and anything, to be perfectly honest. But a lot of traders are not comfortable with that. They will like to trade one index, or they'll like to trade a particular currency pair or a group of currency pairs or one particular commodity, or they'll only trade softs or whatever it is. That's perfectly fine. It's whatever suits you. But you have to accept that if that is the way you set your trading stall out, then at some point you're going to have days like this where you're not going to get the price action. You've just got to be patient and accept the fact that there are going to be days when it's tough. Maybe you don't trade at all. Okay, just to round off very quickly, where do you find all the bits and pieces? This is where you'll find all the indicators at quantumtrading.com. MT45, NinjaTrader we've been on, and TradingView. TradeStation is coming along, I can assure you. It's a fantastic platform. We've got 2 versions. We've got 9.5 and 10. We've got TradeStation Global, which is TradeStation International. That's basically TradeStation 9.5 driven by the Interactive Brokers account. So if you have an IB account, it's a great way to hook it through, link it onto the TradeStation platform, and you can trade through that quite happily, all the markets you would want to cover. TradeStation Trend is TradeStation Securities. Radar screen, fantastic for scanning and all the rest of it. We'll be doing a lot of that in terms of stocks and what have you on that particular platform. So looking forward to getting that launched. Should be in the next few weeks. I know I've been saying that for a while. There's just a hell of a lot of work to do to actually get it all together, particularly in terms of the support pages. So please bear with us. It is coming, I can assure you. Once we've done that, we're going to jump onto TradingView, pull all the other indicators across that are not there, because the Pine script now gives us the functionality we need in terms of object drawing and line drawing. So you will find all the other indicators there. If you invested in the TradingView full package at the current price, which is $600 and something, it's way below the MT45 price. You will actually get all those indicators free as an upgrade, as a thank you from us. So it's not a bad time to be investing in that particular package, because as soon as they are launched, it will be aligned with the MT45 package. So it'll be up at 894. So it's not a bad time to do that. That's where the indicators are. This is the Forex program over at quantumtradingeducation.com. It is the full program because it covers everything you need to know to trade Forex with confidence: psychology of trading, fundamental analysis, relational, technical, the mechanics of trading, and a huge array of 200 hours of video in there, PDF downloads, and the VPA Traders Room as well, which is hosted by Anna and myself. And Anna you'll find over here, annacooling.com. All the books there on Amazon in Kindle and also paperback versions. So they are all there. We're posting stuff up all the time, either on Facebook or here. And that's where it all is. So thank you so much for coming along today. Don't think there are any other questions. No, that's it. Thank you for today. Hope you've enjoyed it. Hope you've perhaps learned something you didn't know before. We are back on, it will be back to Tuesday next week for both webinars. You will get notifications. We just had to do Wednesday today and Wednesday last week for various personal reasons. But we are back to Tuesday for the foreseeable. So it'll be Tuesday morning, Tuesday afternoon, UK time. And as I say, that will run through to Christmas on this series. If you have any questions, happy to answer them. David at quantumtrading.com or Anna at annacooling.com. You can find us there. So thanks for coming today. Hope you've enjoyed it. We will see you again soon, and enjoy the rest of the trading session. Probably going to be a bit muted up until the FOMC, and hopefully it will pick up thereafter. Enjoy the rest of the trading week, and we will see you again next week, God willing. Stay safe, enjoy the trading, and see you again soon. Bye for now.